Folks, you better buckle up. This morning, Gamestop broke out to a level we haven't seen since May 2021. And in today's video, we're going to be discussing the setup on how far this can climb, what history suggests is coming next, the latest going on behind the scenes with the short squeeze setup, and the best strategies to potentially play it. And then we'll be going into AMC. AMC broke out pretty aggressively itself this morning as well. It went all the way up to $13.30. They also announced they completed a $250 million share offering. I'll discuss what that means for spikeability and whether this offering being behind us is indeed a positive catalyst. We'll also talk about the one advantage that AMC actually does have right now over GME. And we'll get to work in a second, but first, quick plug, we are officially launching our Squeeze 50 sales. Squeeze 50 will get you 50% off our options membership, which includes our step-by-step lessons, private Discord chat, and options alerts. But what are some of the recent alerts, Charlie? Well, thank you for asking. We alerted GME calls yesterday, and those ran from about $9.38 to $35.70 at highs this morning, a roughly 279% run alert price to highs. We alerted AMC calls yesterday. Those ran from about 88 cents to $4.80 at highs, a roughly 443% run alert price to highs. Obviously, we're in a very hot market right now, and these are some of our hottest winners. But if you're looking for well-researched, in-depth options ideas and an overall program that is very, very well made and for beginners, well, I'll put the link down below for you to learn more. Squeeze 50 will get you 50% off. Okay, let's go ahead and get to work. So the meme trade is just getting started, and how do we know this? Well, we know this because we are in the beginning of the awareness stage. People are just waking up now and getting engaged. You look on Google Trends, searches for GME and AMC are just starting to go up, mimicking a lot of the trends that we saw during the first cycle back in 2021. You have tens of thousands, if not hundreds of thousands of folks that have essentially been completely asleep and dormant since 2021 meme era runs, and they are just starting to become aware of the situation here and wake up. And a lot of them are choosing to hop on the trend and into the stocks, and when that happens, it causes the prices to go up even further and attract more and more attention, which is a big self-fulfilling prophecy. Now you go and you pull up the chart on GME. Well, GME yesterday went from around $17 to 38 at highs and then sold off to 27. That was a drop of about 29%. It later went on to more than double in today's pre-market to $80, and then it went ahead and sold off again to $35 at lows. That's a drop of about 56%. Now, the reason that this is important is because when you are in a momentum cycle, the bigger the drop, the more the rebound effect. It's like a trampoline. The further you go down, the further it'll shoot you up. And assuming the springs of the trampoline stay in place, which seems to be the case here, well, we should be in the exact same situation where you're going to see a much bigger shoot up the next bounce. But why is this the case though? Well, it's because huge dip buys allow the opportunity for people who are late to the game to buy in at substantially discounted entry prices. It allows shorts that don't want to mess with this a second time around, don't want to mess with a big meme resurgence, to essentially cover before the next rebound. And it overall gives time for the next wave of upward sentiment volume to flow back in. Now, what many are shocked about is the sheer resiliency that both GME and AMC have had through countless halts. Volume that is coming in right now is completely undismayed, which is a very, very strong indication for further uptrending, especially when you're talking about GME. Now, let's talk about the next catalyst, which I believe is a Gamma Squeeze 2.0. So many people trade GME with options, and when people buy options, the market maker has to fulfill said options. And in the last couple of days, a ton of out-of-the-money options that wouldn't have been anywhere near profitable when GME was trading in the $15 region are now suddenly very, very, very profitable, which did cause a bit of a gamma squeeze on the way up. But you have a lot bigger of a gamma squeeze coming as some of these farther out options get closer and closer to expiration. You see, market makers, as of last week, had no idea that 30, 40, 50, 60, or even 80 strike calls had a high likelihood of expiring in the money. But now they do. So what happens next? Well, the longer the price stays near those levels, the more shares market makers are going to have to buy in order to hedge against that risk, the risk of losses on paying out those options contracts, improbable contracts that are now very, very probable. And that is what is called a gamma squeeze, not to be confused with a grandma squeeze, which is when your grandma feeds you too much food and you get fat and you can't leave your door without squeezing out of it. But anyways, I want to show you the short seller situation here. If you're a short seller thinking you want to short the heightened GME price, well, according to iBorrowDesk data, borrow fees have come from some 8.1% as of May 10th to 21.9% as of today, May 14th. And the amount of borrows available have dropped dramatically. Now, these just record the public borrows available, but the truth is that the dark exchanges are probably not much better in terms of rates, because otherwise brokers would simply be incentivized to simply lend them out publicly, right? Why settle for 5, 6, 7, 8% rates when you can go onto the public exchanges and settle for 20%? So what's the point that I'm trying to make here? Well, the point is that firepour for shorts to push the stock down via shorting is getting more and more limited, which we love to see. Yesterday, we talked about how the effective short interest is probably around 43% if you use the public numbers we have and you subtract direct registered shares and Ryan Cohen shares, which are essentially locked out from being lent and don't move much. And when you look at that 43% short interest, you got to start thinking, okay, wait a second. If even a quarter of those short sellers want to start covering, that is going to chase the price up so aggressively that everybody is going to see a massive return, which again, I mean, is the whole thesis for why people are buying right now. Next, I want to bring you over to the Roaring Kitty angle. The big reason that this meme revival is back on right now is because of Mr. Roaring Kitty. And if you look at all of the Twitter/X videos he's posted, it seems obvious he's been planning this for quite a while. The question is why now? And is he just going to stop and let the attention die off? Well, I think there's a reason he chose right now, and I think that he's not done giving this stock attention. Now, there's two angles that I believe that he is playing off of right now. Number one, there was a huge divergence between GME short interest and GME's price. As the price went down, shorts actually decided that it made even more sense to increase their shorting positions. That's like the short seller equivalent of buying a stock after it's run up 5,000%. Like, sure, it could keep running, but you're leaving yourself open to a huge blowout. And number two, unless he secretly sold all of his shares, he likely still has a massive position. In April 16th, 2021, Roaring Kitty said he had about 200,000 shares of GME, which split adjusted would be 800,000 shares. 800,000 shares at last week's trading price of $10 is $8 million, but 800,000 shares at this morning's highs of $80 is $64 million, a $64 million position. So I mean, a few weeks of planning meme videos to see a potential 8x in wealth growth and media coverage resurgence is not a bad idea. And good luck trying to get him into trouble. All he did was post memes. He didn't even talk about the stock. He didn't even mention the stock. It's not his fault all these people bought in. So folks, I think the combination of ripe short interest with the huge incentive to drive interest back into the stock, the tens of millions of dollars incentive to drive interest back into the stock, well, I think those things are what made him post, and I doubt he's done now. I think he saw the setup, I think he likes the money, and I think he likes the celebrity. Clearly loves the attention and drama. That's why he's posting all of these video clips that are very well thought out and very cryptic. And hey, kudos to him. Lots of people in the big money world, big hedge fund guys, they'll go and they'll take massive positions in a stock, whether to the short side or to the long side, and then they'll go on CNBC and all the mainstream media outlets and talk up their position. If it's a short position, they'll say only bad things about it. If it's a long position, they'll say, oh, I can't believe how great this company is. Everybody should buy. And then all of a sudden they make money just by talking about it. Next, let's talk AMC. So for whatever reason, a lot more people are interested in AMC on Twitter and in the media than on GME. I don't know why that is. I think it's largely because the share price is lower per share, so retail gets more excited. Again, when it comes down to the difference between GME and AMC, for me, the big difference between AMC and GME is that AMC has just raised so much capital, created so many shares over the last couple of years, where GME has done virtually nothing. And the problem with AMC is also it's really difficult to risk manage when you have constant dilution. Even today, we got another one of those press releases from CNBC, quote, AMC raised about $250 million of new equity capital, completing the sale Monday during the revived meme stock craze triggered by the return of Roaring Kitty. The movie theater operator sold 72.5 million shares in an at-the-market equity offering that it launched on March 28th. AMC sold that stock at an average price of $3.45 per share before commissions and fees, the filing said. Now, here's the thing. I've been upset about how AMC's share count has expanded. I talk about that every time I talk about AMC, but at the same time, it appears here that retail is trying their best to give AMC a chance, a millionth chance at redemption. I'm hoping that after this offering closed, which it closed today, that the board decides to take that chance and allow no new offerings to go through for at least a few weeks. Now, I'm not going to say that I'm excited about AMC because while I am hoping for that, I'm also not naive. Fool me once, shame on you, but fool me 20 times, shame on me, right? That just means I'm a moron. But here's what I will say with AMC stock. AMC is set up to run, and it can run a lot if the board doesn't decide to do what the board always does. If the board simply decides to hold off on diluting more. And the one advantage it does have, again, is that it does have that lower share price than GME, which makes it a lot easier for retail to acquire shares. But at the end of the day, if you're going to choose between one, GME or AMC, I still think that GME is a far better squeeze setup. AMC, they're just too dilution heavy. They just have too big of a float now, and the board just doesn't seem to really respect its shareholders. But anyways, folks, look, bigger picture, there is something big brewing with all these short squeezes because it seems like everyone in the media is freaking out. This morning, you had a lot of negativity from the elites, intellectuals about this GME rally. Former SEC Chair Jay Clayton says he is bothered by the GameStop GME situation and is questioning whether the U.S. government should get involved. He pointed out that the massive swings in stock prices based on tweets and speculative buying resemble gambling more than genuine investing. According to him, these activities could potentially undermine the integrity of financial markets. And this sentiment is being echoed everywhere.
It bothers me on many levels. I think your last guest got it right. It's a lot closer to gambling than it is to trading, and it's certainly not investing.
And it's very, very interesting to me that retail folks deciding to buy a stock is undermining financial markets, but Congress trading on privileged information, hedge funds buying up single-family homes, and brokers allowing trading against their own retail customers is just good business and good for markets, I guess. The truth is, folks, that a lot of these people just simply do not want the little guy to succeed. If you try to climb up the ladder, they'll force you back down by raising your taxes, devaluing your dollar, changing your regulations, supporting your competitors, and if you do manage to beat those odds and become successful, they'll use half of your money to fund foreign wars. It's quite frankly genius, and if you complain about it, they'll call you uneducated or unempathetic. So anyways, folks, when you're seeing all of this reporting about how stupid retail traders are and how people don't understand that they're buying based on memes and they're not genuinely investing, well, you got to understand that people aren't buying based on memes. They're buying because of the short squeeze setup presented by the memes. When a meme results in widespread attention and volume and buying pressure for a stock that is heavily shorted and in many cases predatorily shorted, well, all of a sudden you have a huge short squeeze setup. So this isn't about, oh, you're not genuinely investing. This is playing the game like they play it. Anyways, folks, that caps off today's video. Let us know what you think about GME and AMC down below. Make sure to take advantage of that Squeeze 50 coupon code, and we'll see you in the next video.